I put a little PowerPoint together for you guys. Stick around for the entire thing. I'm going to definitely give you some information that's going to help you in risk management, because understanding that risk management is a mental thing that you have to get your mind to accept that you need to do and stick to in order to stay in the game of trading. Okay. Risk management is the only thing keeping your account alive. Without it, you cannot trade another day. You can't even play the game of trading if you do not master this. Risk management supersedes psychology. It supersedes edge. It is at the peak of your process. Okay. So risk management is the lifeline of your account. It is what allows you to trade another day. This is why no opportunity can be forced and no rule can be broken to ever chase a loss. All right. Capital is everything. Without capital, guys, you cannot trade. So protecting the capital is number one, is your number one job. Understand this important fact. And these are the things that actually helped me get to a place where I accepted that I had to use risk management in all situations. Opportunity is infinite in the markets. There will always be another trade. So you never, ever, ever need to over risk or risk your entire account on one trade, because one trade, no matter how good the setup looks, no matter how confident you think you are that it will play out in your favor, one trade will not make your trading career, but it can break your trading career. I'm going to say that again. One trade, no matter how good the setup looks, no matter how promising and confident you are, no matter how many confluences you think you have that align that tell you that this trade is about to be a banger, that one trade 9 times out of 10 will not make your trading career, but it could break your trading career. Okay. So understand that. All right. So I'm going to go over about 3 different types of risks. All right. I'm sorry, risk. And these are just 3 of the typical ones that a lot of people tend to flock to, but I'm just going to explain them to you. So first is going to be fixed risk. Okay. You risk the same dollar amount every single trade, regardless of the account balance. All right. So this looks like this. Let's say you have a 100K account. You're going to risk $1,000 per trade every single time, regardless of whether you win or lose a trade. You're going to still stick to that $1,000 risk. It's pretty simple, it's consistent, and emotionally, it keeps you from having to guess and think about how much you want to risk on each individual trade. It does not matter how confident you are in a trade, how not confident you are. You stick to your process and you execute your process, all right? And you only risk $1,000 per trade. The only thing about this fixed risk is it doesn't really scale the account automatically as the account grows, which is okay. All right. It's about being consistent. And I recommend this type of risk if you have trouble managing your risk as is. This takes the thinking out of it. Number 2 is going to be percentage risk. All right. This is probably the best, most safest risk management method there is for trading. All right. You risk a fixed percentage of your current account balance on each trade. So if you have a 100K account, 1% of that is going to be $1,000. You're only going to risk $1,000. Let's say you grow the account to $110. You're still going to stick to 1% of that balance, which is $1,100. The beautiful thing about this percentage-based risk is it scales automatically and it shrinks during drawdown. So it actually, this is like the best method you can do, because it allows your account to grow at a very, very rapid rate if you're consistent, right? But it also protects your account from blowing itself, or from you blowing the account if you do find yourself in a losing streak. It shrinks down pretty fast. So to give you an example of that, let's say you lose $1,000. Now your balance is $99,000. Well, you're going to risk 1% of that. Let's say you lose again, another $1,000. Your account, you lose again. Now you're going to risk whatever the percentage of your account that is. So it's really safe and conservative, but it can compound up fast, and it protects you in drawdown or losing streaks. Okay. So only tough thing about this one sometimes is the risk amount changes every single trade. So you do have to track that. But other than that, really great method, one of the best. Okay. Next is the account division model. Now this is going to be a lot more aggressive. Okay. This is going to be a more aggressive approach. What you do is you take your account and you divide it by 20, 30, 40, 50, whatever you want to do, and to determine how much you risk per trade. Understand that when you take an account, let's say 100K account, you divide that by 20, that lets me know it will take me 20 trades in a row, risking $5,000 per trade to blow my account. This is more of an aggressive model. I recommend only using this if you are confident and you have somewhat of a proven track record to yourself that you are consistent and your edge works and you consistently execute your process over a nice sample size of trades without making mistakes or going against your rules and things of that nature. So yeah, good thing about this is built-in position sizing discipline, right? but your risk per trade can feel large, especially if you're a new trader. You may not be that comfortable with it, which is okay. But at least you do have the peace of mind of knowing, like, hey, if I lose 20 trades in a row, I blow the account. If I lose 30, 40, 50 trades in a row, I'll blow the account. So it does give you that bit of comfort and confidence, okay? So to go deeper into the fixed risk, all right, this is why fixed risk works, all right? Again, fixed risk, let's say you have a 100K account, you're going to risk 1% per trade. No matter whether you win or lose, you're going to stick with this $1,000 amount, which is the risk amount of the initial account balance, okay? Why this works, you use the same dollar amount, dollar risk amount every single trade, all right? Your emotions, again, like I said, they stay flat because you know exactly what you're risking before you actually get into the trade. All right. Number two, this actually helps you survive losing streaks. Let's say you have 10 losses in a row. Well, you're only going to be down $10,000. That's still 90% of your account left intact. Let's say you lose 20 trades in a row. Your account will be at 80,000. Let's say you lose 30 trades in a row. Your account will be at $70,000. Still in great position to grow and come out of drawdown, right? And if you actually know what you're doing, if you're patient, if you're sticking to your process and executing how you're supposed to and managing yourself and your emotions how you're supposed to, you shouldn't even go 20 losses in a row. Depending on your strategy, though, some people it could happen, but again, you shouldn't, right? It's easy to track and journal. Okay, it's pretty simple math, not much to think about. So it's consistent data across all your sample sizes, all right? And then again, the emotional aspect, emotionally, it is very consistent. You already know your max loss before you enter a trade, which means you have to accept that loss. Okay, you're it's a lot easier to go into your next trade accepting the risk when you already know what it is. You don't have to pre-calculate or figure it out or anything like that. All right. Never exceed your fixed risk to try to recover a loss. Never, ever do this. Understand that fixed risk is more than capable of recovering losses, especially if you take trades where you have a decent to high risk to reward, okay? It will recover the losses itself. You just have to continue to execute the process, all right? So here I gave you guys a 2-week scenario, just showing you how this could look. This is just a simple scenario, right? Doesn't mean it will happen just like this, but this could happen. So let's say you have a 100K account, $1,000 fixed risk, minimum risk to reward is 1 to 3, and max trades per day is 3 trades per day. Really, that should be 2, but we'll just say 3 anyway. So let's say Monday you won $3,000, but the next day you lost 2 trades, you lost $2,000. Next day you won $3,000 your first trade, you lost your next trade $4,000. Next day you lost $2,000 on 2 different trades. But let's say Friday you had 2 good trades, you made $3,000 each, right? Monday you lost $1,000 on your first trade, second trade you made $3,000. Tuesday you lost $2,000. And as you see, go on and so forth, right? After you tally up these days, you factor in these losses, right? You have 4 losing days out of 10, all right? 40% of the days were red, but your total P&L still comes out to be $14,000 in just 2 weeks, okay? This goes to show you the power of risk management. Risk management did this, not the win rate or the risk to reward, but risk management. This is why it's so important, because you see on the days where you lose, you only lost $2,000, okay? But the days where you won, you made substantial profits. And let's say you have a day where you actually hit more than a 1 to 3 risk to reward. Let's say some of these days were 1 to 5s, 1 to 6s, 1 to 7s, 1 to 12s, whatever. That would just show you how much more money you would have. Your losses would look the same, but your profits could be dramatically different depending on the risk to reward. So this is just a basic example of showing you how it looks when you stick to risk management over a period of time. Okay, so this is a beautiful one, right? Understand something. Your edge doesn't show in just 5 trades. It shows over a large sample size of, let's say, 100 trades or more, okay? And you have to think about it like the casino. Again, the casino, they're not worried about you winning a hand in blackjack, or they're not worried or stressed out about you winning a spin on the roulette table. They know that over a series of spins and over a series of hands, you're going to lose because they have an edge over you. You're going to lose. So you can come in the casino and you might win 2 to 3 spins in a row. You might win 10 to 15 spins in a row, but they know that the longer you stay and the more you keep spinning, the more hands you play, their edge is going to take over and they're going to win. All right, so let's break this down, right? With just a 50% win rate, with a 1 to 3 R to R, risk to reward, and risking $1,000 per trade, right? When we do the math on that, let's say you take 100 trades and you risk $1,000 per trade with a 1 to 3, and you only won 50 trades, you would have made $150,000. Now the other 50 trades, the other 50 trades that you didn't win, because out of 100 trades, you only won 50 and you lost 50, you would have still profited $100,000 after losses. Okay. So moving into an even lower risk to reward, win rate, 40%. Let's say you won 40 trades and you lost 60, right? So out of 40 trades, 1 to 3 risk to reward, risking $1,000 per trade, you would have made $120,000, but you would have lost $60,000 because of the 60 trades you lost. Well, the net profit is $60,000, right? And then all the way down to a 35% win rate. Again, you only won 35 trades and you lost the other 65. So you came out with a net profit of $40,000. This right here just again proves when you use risk management, the win rate does not matter. Risk management alone can still cause you to win trades or come out profitable in the long run. Okay. So now another thing I want to talk about is stop loss placement. You have to be very careful about where you place your stop loss. You do not place your stop loss at a round number. You don't just pick a number. Oh, I'm entering at 58, 400. I'm going to put my stop loss at 58, 300 because it's super tight. No, you don't place your stop loss based off of a dollar amount. Well, I only want to risk $400, so I'm going to place my stop loss here. No, you don't move your stop because the trade looks like it's reversing and about to come back to entry. You don't move the stop against yourself ever, right? And you definitely don't trade without a stop loss at all. And you don't place the stop loss too tight because you don't want a big stop loss. You want the trade to look pretty. All right. None of those make sense. You want to always, always, always put your stop loss at the point where the setup will be invalidated. Okay. So in order to figure that out, you have to ask yourself, what would make this trade wrong? What would make this trade idea, this buy trade or this sell trade that I have decided to take, what would deem this trade as invalid at what point? And that's where you want to place your stop loss at that point, right? So you put the stop there, right? And you have to make sure you size your position around that stop loss. So sometimes you will have to calculate, okay, since my stop loss is going to go here and I'm going to risk $1,000, I have to calculate the ticks, the pips, the points, whatever, to adjust my stop loss to be $1,000 at this stopping point. All right. Once you place that stop loss, you do not move that stop loss any higher or any lower against your position. You never do that. If anything, you move that stop loss to break even, or you move it into profit, or you simply mitigate the risk as the trade goes in your favor. All right. A stop loss is not an option. It is the line where the trade ceases to exist. Okay. It's not an opinion. Yeah. I'm sorry. I should say option. But anyway. All right, so here's some rules, okay? And these are actually rules that I go by myself. I never exceed 3 trades in a day, all right? I never do. If I lose 3 trades in a row in a day, I couldn't get my shot off in 3 trades, I'm done. It's over with. It's no point in still looking. I have a tight window I trade in anyway. Next, I never move my stop loss against my position. I don't care if it looks like the trade is reversing, is about to take me out. I will let that trade take me out before I move that stop loss deeper into a bigger stop loss. Like, it doesn't make sense. You're here to protect capital. So if the trade is wrong, it's just wrong. Accept it. You never revenge trade. Again, this is why I say you have to have an abundant mentality. Okay. There are inevitable opportunities in the markets. You literally can take a trade, lose, and within seconds, a new fresh opportunity can appear that you can take. So it's no need to ever revenge trade or try to force a trade. There's no such thing as getting anything back. All right. Takes me to my next rule. Never break a rule to recover a loss. Understand something, guys. It's so easy to build habits in your trading that if you build the wrong habits, it makes it hard to break them. It's very hard to break habits. It's very easy to make new habits, whether they're good or bad. Okay. And understand that even if you win a trade, but you broke one of your rules to win that trade is still a loser. The reason being is because you're training your mind to make exceptions under certain circumstances and conditions to go against your trading plan, your process, your rules, which in turn, if you make that a habit, that will come back to bite you later. Okay. So last but not least, never trade outside my execution window. This is for me. I trade between 8 a.m. and 11 a.m. New York session Eastern Standard Time. I do not trade outside of that window. If I'm in a trade or have an active trade past 11 o'clock a.m., I'm managing that trade only, taking partials, BE, whatever the case may be, but I'm not adding any positions to that trade. I'm not taking any more trades. Okay. Next, I'm going to talk a little about something called risk on, risk off. Okay, so now this depends on the market conditions. All right, this tells you how aggressive to be. This is if you're using that first risk model I told you about, the account division. All right, but you can also use it during the other risk management models as well. Risk off. I'm sorry. Risk on is going to be understanding when to use full size and when you're executing confidently. Okay. So let's say the market is giving clean, readable setups every day or daily. Let's say that your win rate right now is currently trending above 50%. Let's say high volatility sessions and they're giving clear direction. Let's say macro conditions are favorable, right? The markets are trending, or let's say you're just mentally locked in and executing well. All right. Under these particular conditions is when you want to practice something, or you could practice something called risk on, where you're just being a little bit more aggressive, but still within bounds and sticking to some type of risk management protocol. All right. Now, risk off, which is going to be more important. When do we need to know to reduce size, trade less, and protect the capital? When the markets are choppy, when they're ranging or unreadable. Okay. If we have 2 to 3 consecutive losing days in a row. All right. Let's say we got major news events, they're causing erratic moves, low volume periods such as like holidays, summertime, stuff like that, or you're just mentally off, you're distracted, you just don't feel your best mentally, you're not on your A game. This is when you need to be, turning that risk down, reducing the size, trading less, and just being more picky and selective about the setups you're taking. Okay. Understand that reading conditions is not weakness. It is a professional risk management skill, and it really is. It takes time to develop. All right. So this is a basic drawdown protocol. All right. How do you survive a losing streak and rebuild your account? So let's say phase one, the trigger is you lose 3 consecutive days in a row. And let's say your risk was at $1,000 per trade and you lost 3 days in a row. You lost $9,000, which is okay. It is completely normal to lose 3 days in a row. It honestly could happen, and nothing could be wrong with your strategy or your edge. And you still may be mentally super clear. But here's the kicker: when we have significant events like this take place, meaning we lose 2 or 3 days, typically 3 days in a row, we want to start doing some self-evaluation. Am I mentally still in check? Are the market conditions changing? Am I still executing my edge and my trading process how I'm supposed to, right? But either way, no matter what the answers to those questions are, we still want to go ahead and reduce the risk, okay? So we want to reduce the risk, cut that risk percentage in half before day 4 starts. All right. So the next trigger, let's say you continue on the reduced risk, and let's say you lose another trade, you lose again, you're still on that losing streak. You want to cut the risk in half again and go ahead and start protecting what remains. And you pretty much want to stay at this stage until you begin to recover those losses. Now, if you happen to blow your account or you get close to blowing your account, I have another parameter in place where if I've lost like 50% of my account balance, I need to completely take a break from trading and maybe sit back for a week and let the market settle, do some evaluation to make sure I'm still mentally in tune, or I'm thinking about things the right way. I need to do some serious back testing to make sure that I'm still on point mentally and executing how I'm supposed to. I just need to identify what is actually going on. Is this just a natural cause of probabilities playing out? Or is it me not doing something I'm supposed to do? Is it me doing things I'm not supposed to do? Or is it the markets and the conditions are just changing? All right. But if I get to 50% of my account balance is gone, I'm doing some serious evaluating and keeping the risk here. Right. And then, of course, how you begin to rebuild is once we brought the risk all the way down, we begin to increase that risk by 25% increments as we start to recover and get back to certain milestones. We'll start to add that risk back into play. Okay, so the goal during drawdown is not to make the money back fast, but it's just to simply survive and stay in the game. Because understand, depending on your strategy, your edge, you could very well lose 3 to 4 days in a row and nothing be wrong. It just simply is probability playing out. But in those times, we want to make sure that we are protecting our capital. Okay, so another system of approach you can use for scaling up is having certain milestones. At certain milestones, that's when you decide to increase your risk percentage. Okay, so you can have an account balance of $100,000, risk 1%. Let's say the goal is to get to $10,000 in profits. Once I get that account balance to 110, then I go up to 1% of 110, so on and so forth, and do it like that. You can easily do this, and it works the same way with if your account is declining as well. You can be doing the same thing. All right. All right, mindset. This is very important. This is the number one reason why most people struggle with risk management is a mental reason. Okay, they do not necessarily see or understand or they have yet to embody the beliefs and understandings of risk management and how it protects them more so than holds them back. Most traders, new traders, think that risk management holds them back versus them actually seeing how it protects them and allows them to grow over time and stay in the game. Okay. So these are just some beliefs I have, all right? The beliefs that separate traders who survive from those who don't. Every dollar I risk is just the cost of doing business. It's not a loss until you exit, and even then, it was just the fee for that trade. That's how you have to look at your losses. This is the cost of doing business. These are the fees. This is the tuition, okay? This is just the normal things that come. This is just like paying taxes, all right? Next, I don't need to know what happens next to make money. Profitable trading is about probabilities over a series of trades, not trying to predict each and every trade. Again, just like the casino, they're not concerned with winning every hand or winning every spin. They know that over a series of hands and a series of spins, if they execute their process consistently and they have an edge in the gambling space, they know that they're going to be profitable. Okay. Next, any loss can be recovered. Opportunity never runs out. The market will give you another setup. It always does. So stay in the game. Understand that when I'm saying I can recover any loss, this is not saying like, okay, I just lost, I can recover that, because you don't want to make the habit of focusing on the last loss and trying to recover that loss. You want to focus on the process, but you want to have a inner belief in understanding that opportunity is inevitable in the markets. All right. I have taken so many accounts into deep drawdown in my earlier trading days, and I managed to start using risk management and bring those accounts back out of drawdown into profit and get withdrawals. I've done it multiple times. I mean, I've literally beaten accounts all the way down to a few $100s and brought them all the way back and still got payouts. Okay. So understand that opportunity is inevitable, but you got to use risk management to stay in the game. And last but not least, this is the most important one, okay? Your focus needs to always be on executing the process, not the outcome. The P&L is simply a byproduct of executing correctly, okay? So shift your awareness to the process. What does this mean? Because this is so critical that you get this ahead of time. Every single day that you trade, you should be focused on executing the process. You should not be focused on taking beautiful setups. You should not be focused on making some money. You should have your mind actually thinking about and focused on the idea of executing your trading process as perfectly as you can. Because understand that your trading process is designed by you to make the money. So if you focus on the process, a natural byproduct of executing the process properly is to be profitable over time. That is what you have to focus your attention on. All right. So understand lastly, the traders who survive long enough to be profitable, they are the ones who master risk management first, because strategy gets you in, but risk management keeps you in the game. So I say all that to say, stay focused. Risk management is key. If you master this, it's going to make everything so much more easier for you in the long run.